think.
Let's see. Maybe it's still live.
I'm not sure. I think we are live. Yeah, should be. All right. Welcome to Capital Races Club. Today we're talking with Amy Tiemann from Tiemann Properties, and super humbled and grateful to have you here with us, Amy. We'll get to learn from you. And any questions from the audience that we see in the comments, feel free to put them here in the comment section, and that way we can get to them during this live stream. So, all right, that's it. Could we start with, how did your journey begin in commercial real estate? Tell us a little bit about yourself and how you got started in real estate, please.
Okay, sure. So, back in 2003, I was working for a tech company in Austin, and my husband at the time had started a construction company, and so I was helping him on the side, kind of, keeping the books and keeping everything square and doing what needed to get done. And I had been in tech for a while, and it was during the downturn. A lot of people, I don't know if everybody remembers, but in 2001, there was a downturn too. And this was the .com bubble. And so we, there was a recession from that, happened probably after 9/11 happened, like we were toast, right? So, but the .com kind of had burst prior to that. And then, so I was a part of a tech company, and I was in HR. And so I'd gone through 8 layoffs, like no joke. Like I was handing out layoffs to rounds and rounds and rounds of people. And I survived all the layoffs, but the problem was I just didn't agree with some of the decisions that were made. And I just was not, I was like, this is not me. This is not what I want. I don't want to go on the ups and downs of tech. I don't want to have to, do this anymore. So my husband, he said, well, you're working for me anyway. So let's just start the company. Let's grow it. So we did. We started working together full time. And then we grew that company to be a national commercial general contractor. We were building stores in 16 states. Like in 2014, we hit our 16th state. Building retail stores for lots of different clients. Our biggest client was Easy Corp, and they were one of our best clients. And they took us around the country building easy pawns and easy monies. They used to have a payday loan business, and that was a lot of our construction was around their payday loan business. They don't have it anymore, but they did. And so they were building a bunch of payday loans, and so we were building those. And I built from, honestly, I didn't make it to California, but we were up a bunch in the Midwest, down in the Southeast. I built in Florida, Georgia, like all over the place. And so along that journey of being in the construction company was we'd started real estate investing. So our very first real estate investment was in 2008 when that was not, like our personal house or whatever. 2008, we went and my kid had T-ball practice. And so while he was at T-ball practice, I was walking around the neighborhood and I saw a house, and it was vacant and it looked like a piece of junk. It looked like just like the perfect flip, right? Like this is like, this will be a great flip, right? So then I looked up the owner, called the owner, got a hold of them, and said, hey, can I buy your house? And apparently it was in an estate. The mother had passed away. And when I got into the house and I was looking at it, and they're like, do you know how much you want for it? And they're like, no. And so I got in the house and I'm looking at the house, and it was, I was so mad at that family for letting their mother live in those conditions. Like it was so bad. And so I lowballed them and I said, I'll pay you $30,000 for your house. Like, and that's all I'm going to give you because y'all are jerks and you let your mother live in this. And they sold it. They sold it. I mean, it was so bad. The plumbing was running on top of the ground.
Oh.
Like through walls. They didn't even plummet in the wall. They went through the wall to another wall, down under the ground. She had holes everywhere. I was like, oh my gosh, how did y'all let your mother live in this? Like, y'all are horrible people, horrible human beings. So anyway, so it was our first thing. I got it at a great great deal. I mean, $30,000 even in 2008 was a great deal. But then we spent way too much money because we were contractors, overspent on a house, barely made any money, totally didn't lose our shirts, but we lost a little bit of money on that house, right? Because we didn't manage it well. It was a bad project, right? Because we were trying to make it beautiful. And we didn't, one of the lessons we learned from that was you got to know what your market income is, and you have to make your product to whatever that market income is, right? So don't make it too pretty because no one's going to buy it. It's in the neighborhood. You have to make it to the comps of the neighborhood, right? So you can sell it because it's a flip. You want to get it out real fast. So anyway, so we didn't do that. We made it too nice. It was difficult to rent. Couldn't even rent the damn thing. So we ended up finally selling it. And lost a little bit of money, but it wasn't too bad. So that was our first deal. And then we got into, buying other single families, renting them. We got into a local real estate investment group and learned along the way and did all that kind of stuff. And so, yeah, that's how we went. And that's how we got started into it. And quickly got into multifamily in like 2010. Got into multifamily in 2010 and just kind of kept going from there.
How did you transition from residential? Because there's a lot of investors who are in our, not just live streams, but also who I meet and talk with, and they never make the transition. How did you transition from the residential space to commercial?
Well, so the construction experience helped, but it wasn't the only thing. There's so many things you have to learn to go from residential to multifamily. So, and the easiest thing or the best thing I did was I was a limited partner. So there were partnerships being put together to buy multifamily assets. And so we came in and we were a limited partner in one of those deals. So like this real estate group is new to the Austin area. And so their very first investment in Austin, we were part of that purchase. And it was during the downturn of 2008. So 2008 happened and a lot of assets got distressed, right? And so we found this 42 unit in Austin, Texas, fabulous deal. We got it for like, I think 37 a door or something crazy, like crazy cheap. And I, we should have never sold it. Like I'm still kicking myself that we sold our multifamily investments in Austin, but or I should have just bought it from the partnership. But at the time, there was no lending happening on multifamily. Like if there was anything distressed, it was crazy weird. You could not get a loan, so we had to go pay all cash for it. So we raised the money to buy it outright. The GP on the deal, so we were the LP, so we were a limited partner, and it was kind of a group. It was more of a group that kind of did it, but it was really cool. It was a lot of fun. But we were a limited partner. Then we were also the general contractor on the job. So we were there day one. So we were there during takeover. We were there doing demo. We were there, all of those things. So which is a really good lesson to learn, because when you're transitioning from single family to multifamily, the scale hits you really quickly. That's one of the things that you find out really fast is just the scale, the amount of work, how you have to manage the systems you need to have in place, all of those different things. And, the amount of people that you need to get a transaction done. Like, I think I counted the other day, it was like 20 people, like no joke, different teams of people that in order for you to actually get a commercial real estate transaction, just closing it is about 20 people. And then after you got to maintain and operate it and make sure that it's, meeting it's performing so that your investors get their returns, right? So, so transitioning from one to the other was an interesting thing. I went small, we bought small, and learned a lot, did all the property management ourselves, learned a ton. I don't property manage now, I just asset manage now, but I property managed in the beginning just so I could learn, and learn the systems you need and, all sorts of crazy crap. Like, you had your leasing agent stealing the application fees and we went through everything, like, people, like losing deposits and like, collection system. There's just so many different kind of systems that you need to have. And and you learn along the way. So start small, because don't go big, because you'll just lose your shirt because you don't know what you're doing. So nobody does. It's your first one. You don't know what you're doing, so go small. So,
would you say that experience of passively investing first helped you out tremendously, or was it just it's a good?
It does. It's the best way to start, and honestly, truly, because if you passively invest in different sponsors' deals, then what happens is that you get to see their different communication styles. You get to see how they do their reporting. You get to see what they kind of, because there is no written rule on, in a private real estate deal, what you should expect as an investor. There are no rules, right? It's the Wild West. So, but you would probably want, as an investor, written reports and different things, and financial statements, and when are your distributions happening, and all those kind of things. And some of those are written in your operating agreements and stuff. So, but I'm of the kind of, my mantra is more communication the better. I try to be very transparent. I try to do as much communication to my investors as I can. And so, and I learned that along the way, like as you're going along, right? Especially during certain key times, it's really important to kind of over communicate. So like during the transaction, we're trying to get it closed, you kind of update people. A lot of people don't, some people don't, but you update people as you go along. Obviously you have your monthly reporting, but it's just kind of an interesting thing. And you just have to understanding the whole, how to manage investors and how to raise capital and all of those different things. When you get into larger and larger deals, those systems that you need to have in order to do that effectively and efficiently, that's the stuff that you learn as you go along, as you scale and grow and do those things. So, yeah.
Would you happen to have any 506C or 506 for passive investors looking to learn now? Would you happen to have any opportunities where they could learn passively investing with you?
Sure. I have a 506C offering right now. I'm buying a multifamily portfolio in a suburb of Houston. It's called Pasadena. It's kind of near southeast, now near by the NASA Center and the refineries in the port. And it's a 506C, so you have to be an accredited investor. And
what does that mean for those that are passive but don't know?
Sure. All right. So to be an accredited investor, there's a couple of rules that the IRS and the SEC say you have to meet. And one of those things is there's an income threshold, and there's a net worth threshold, and then there's a licensing threshold. So the income threshold is if you are a single person, you have to make $200,000 a year or more. And you have to prove that by like the last 2 years. Like I have to see your tax returns, right? Or if you're a married couple,
or how long is that duration?
Last 2 years. And then if you're a married couple, it's 300,000. Then there's a net worth threshold of $1 million or more outside of your personal residence. You can have a net worth of $1 million too, and that would qualify you as well. Or there's a licensing threshold. They changed it this year. So if you have like a FINRA license, like a Series 6, Series 63, Series 65, that allows you to sell securities. Those in sevens, and there's all different ones. If you have a FINRA license that allows you to sell securities, then you're also considered an accredited investor. It's all about I don't know why, but the IRS and the SEC thinks if you got a lot of money, that means you know what you're doing, and so therefore you can invest in investments, and you don't have to like be sophisticated or educated. Is that true? No. I've met a lot of accredited investors that didn't understand it. That doesn't mean I took them in my deal. I made sure they kind of knew, but for right now, accredited investor, that's what the IRS and SEC says. So yeah.
Thank you for explaining that.
Sure.
So the deals that you're currently raising for, is it possible for them to reach out to you that way?
Yeah, totally. Yeah. So the easiest way is to go to my website, which is TM1 Properties right there on the thing. Go tm1properties.com. That's my website. They can check me out, kind of look how we run things, register to invest, look at my offerings. They can book a call with me. They can do whatever they want to do from my website. It's really handy. So yeah.
Thank you for sharing. So when you started out with First Passively, what got you into the active side of being an active investor, a general partner in deals? how did you make that transition? Because that's another big jump, right?
So. Yeah, it is. So going from the LP side, now we were kind of an active passive anyway, because we were, being the GC on the job. But transitioning to now where you're actually the person in charge and raising capital and doing all that other stuff. We first did we bought a 40 unit on our own. So we first took 4 houses that we had. I've been property managing since 2008, since we got our first investment, and we started buying a bunch of single families. So we took some of our single families that we had left over, sold them, and did a 1031 exchange because we bought them really cheap, because it was back in 2008 when we were buying them, right? So we're getting houses really cheap. Our houses that we had, I have a property. Oops. And so anyway, that's okay. And then so then we took that and used that as a down payment on a 40 unit, and that was our first experience as being actual true, on the owner side. So we bought it outright, and then I started syndicating after that, after I bought that 40 unit. And so we managed that one, and then sold that one, and then I started buying others, and then started syndicating from there. I always wanted to be on the GP side. I'm an entrepreneur. I just that's the place I want to be. I want to find the deal and raise the capital, put the deal together, structure the team, do all that kind of stuff. I've been an entrepreneur for a very long time, so I've always wanted to be on that. But I do appreciate my time as a limited partner, because it was invaluable experience. And a lot of people don't realize that the financial statements that you're given as a limited partner are really, really great information for you to learn, right? So when you go underwrite other deals, you should use the financial statements from all the other LP investments that you're given. So you should know what the expenses are, right? You should know what water costs you, repairs cost you, and all this. So as you go underwrite other deals, you can use the stuff that you already have, because you're a limited partner in other deals and you're getting that information every month, right? You should be. So yeah, it's kind of an interesting thing. That's why I liked it. And, but there's other balls of wax to managing and being on the GP side. So, which you learn quickly. you learn quickly as you become a general partner. But yeah, so
let's a question that I don't think I've asked this before. Currently, you've been actively investing for a while now. Yep. You have assets under management, and in the title, I put in a random number, but it's kind of close, right? What is the assets under management right now?
256 million.
Yeah. So for those that are watching this later on, that's quite significant from being passive and then going to active and then going to.
Yeah.
How did you transition from not just active but also to that level of assets under management? That's an incredible trust that a lot of investors have with you. How did you build that trust with them?
So a lot of it is initially. So I was in some investor groups, and that's how I met but a lot of networking and doing those kinds of things. But your investors end up being your best marketing tool, because truly, honestly, at the end of the day, investors know other investors. And so I get calls all the time going, "Hey, Carl's in your deal and he told me to invest with you." Seriously. Yeah. And I get a lot of repeat investors too. So people will invest in one deal and they'll go to another deal. And so, which is nice. And so, but they are, so if you treat your investors correctly, you're communicating to them and you're doing your job and you're buying good assets and they perform and they get great returns, and you're giving them, bonus depreciation, and you're doing all the things you should do that makes their, balance sheets great and their tax returns this. And, if you're doing those things, people are going to like you and they're going to tell everybody about what you're doing. Right. So it's about being a good operator, and it's about, communicating to them and telling them what's going on. And, because every investment's a risk, every investment. Right. No matter what investment you're investing in. Right. It could be crypto. It could be, real estate, it could be gold, it could be whatever asset class, foreign currency, who cares, right? That if you're investing in a business, there's risk, right? So you have to make sure that whoever is running whatever part of that, if that's you or if it's not you, or you got to know that they know what they're doing. And so experience helps now. I mean, since we've been doing it for so long, it helps. Like, right. So I get fairly good. I get fairly good references from current investors, and that gains new investors as I talk to people about my experience, and that'll gain other investors. So, and I also, because I've been doing it for a while, I get a lot of deal flow, in which, I mean, investors got to have something to invest in, right? So you gotta have deals. You gotta have deals. You gotta go find the deals, right? So I'm not just a capital raiser for a fund, and I go fund something. No, I'm actually actively finding the deals that I'm funding to. Which is a lot, and not everybody does that. I will say there's a lot of people who just raise capital for funds, and then they go pick things to stick their money into, and they're actually not managing it. And so I chose to do both because I can, and I think I have better control over the performance of the assets because I'm actually managing it. Now, it doesn't mean I won't take anybody who just raises capital for whatever. I'll gladly take your money, but that's how I do.
What kind of investment deals are your favorite, and what are your investors mainly looking for to place their money to work in?
So I will say that if I tell anybody I can get you a 10% cash on cash return and a 20% IRR, right?
For those that don't know that.
Okay. So 10%. So cash on cash return basically is not including the money you invested in, right? So it's the cash that you're getting every year on average, right, from what you invested in an investment with me, right? The IRR is return of any capital to you. So like if we refi and we profit from the refi, and I've returned your capital back to you and plus, right? And then any sort of profits from the sale, and it's the cash on cash is just the distributions amount that I'm giving you, right? The IRR includes all points of refi and all sorts of different things, right, that you're doing.
What's a refi? Because I know these questions come up a lot.
Oh, okay, that's cool. I'm good. So stop me when I'm doing. This is great because
I'm starting to learn now that our audience sometimes have these questions and they're looking back on them. Cool. So what's a refi, and what does that mean when it comes back?
So when you refinance a property, typically I do what's called, there's another terminology, value add reposition, but I'll define it. So I buy ugly and I make it pretty, right? So I'm just like on a house, when you're flipping a house, but I just do it on commercial property. So I go find an ugly building and I make it pretty. And when I make it pretty, the value goes up because I can rent it and get more people in there because it's pretty. And then I can refinance out of my existing debt, whatever I used to buy it with. And when you do that, you usually have a higher valuation when you do your refinance, which is a refi. You do your refinance. So most people have bought houses or they've refinanced homes or whatever. That's all the same thing. So you're refinancing the problem, but that because the value is now higher, right, than what I bought it at and what I spent to make it pretty. Generally, when you refinance out, even though your refinancing is only 80% or maybe it's 75% of whatever your new value is because you made it pretty and you rented it out and it's making money, that still sometimes is even more than what we put in the deal. So then I'm able to return money back to the investors that helped me buy the deal because we've increased the value so much, right? So that's kind of when you do a value add reposition, that's generally the cycle. You buy it cheap, it's ugly, you make it pretty, you make it profitable, you refinance it, right? And then the investors get to profit in that too. And then you hold on to it. You still have your distributions to do whatever. You might not have any money in the deal at all. It doesn't matter. You're still in the deal because you still have ownership. You still have your ownership. And then I continue to pay you distributions along the way until we choose to sell, which might be, 3 or 4 years or 5 years later. We never sell, we refi again, who knows? But normally we sell. Most investors, their preference is like 5 to 7 years to sell. It's a risk mitigation thing. But so that's that's how the game works. And so you just do it that way. And then, and then
how much of this does a new investor who wants to actively or passively invest, how much do they have to understand before they get into it? Is it because for me, it's taking a while to understand all of these, but for a passive investor, what would you say?
I would say you need to know how to read financial statements. You have to know how to read them. And you have to, and just to be on the safe side of understanding how that property is performing. There's great resources. There's a book, I think the last guy's name is Michael. I'm going to say this. He has like a book on all investment calculations for real estate. I think it's Waltrip. I think that's his last name. Anyway, he explains IRR. He explains cash on cash return. He explains all these different calculations that people use to underwrite real estate deals. It's great. That's a required reading. If you're going to become a real estate investor, you have to read that book. You have to be able to read financial statements because you're going to be getting them every month. And that's communication. As a sponsor, I'm communicating by sending those financial statements to you. So I'm sending you my little summary of what's going on. But I expect you that you can read those things so you know how the asset's performing and not performing.
Yeah. Would you say the book 36 Key Metrics and other 36 other key metrics by
That's
Bellinelli. Is that the book that you're talking about?
I think so.
All right. That one we can.
It's calculations. It's about calculations. How you
we will put it in the chat, or we will put it in the description for resources that the audience can go to later. A question that came up earlier was, what would you say are the most important lessons to learn to set you up for success when raising capital for a deal? Because you've been talking about raising for these deals, and now what would you say for an active investor looking to raise is these are the most important things to focus on right now?
So every real estate partnership, so it depends on where you are in the chain. So every real estate partnership needs a deal, it needs money, and it needs experience, right? So, and the experience helps you get the loan, and the experience helps you manage the asset. The money is required to get the deal done, whether it's debt or equity, you got to have money, and then you got to have a deal. So lots of people who get into this game can provide value in one of those three areas. So, it could be, if you don't have experience, well, maybe you can find money, or you can maybe find the deal, right? So when you're looking to raise capital or getting started in there, you might be able to provide value some way, and then watch how other people raise money, right? And watch how other people go, and it's a lot of networking. So those three things are key. You get yourself involved somehow and watch how other people network, and how other people have connections with whoever. But at the end of the day, raising capital is all networking. It's all meeting people. It's all talking to people, because everybody says this, they got to know, like, and trust you in order to give you your money, which is very, very true. I will say, I'm finding now that as you brand yourself and more people know you, more people will trust you. And it's not from an interaction that you have with them. It's going to be an interaction that somebody else had with you, that they're now trusting that person, and that person's referring you, right? So I'm getting some of those now, but that takes time. All of that takes time to build. You have to be marketing yourself all the time. Like, you can't stop. I learned that lesson a long time ago when I was on an investment. I kind of stopped marketing. So you have to market yourself all the time. You have to... And the easiest way to market yourself is by having something for people to invest in, so, finding a deal, getting on a partnership, getting with a team, being able to raise money for something for people to invest in. If you're the person who has good deals, then the money will find you, right? But that is not an easy, I mean, that statement I just said is true. That does not mean it's easy, you know? And so everybody, like, it's like that, you know, easy, real estate is a get rich quick scheme. And everybody equates getting rich, and it is, you can get rich quick. Like, no joke, you can. Like, the most quickly is for anybody, but that does not equate to easy. It does, everybody equates it that it's just easy, right? And it's not. Yes, you can get rich quickly, but it takes time, and it takes a lot of hard work, and it takes a lot of effort, and all of those things. So you have to put the effort in. If you're going to raise capital, you're going to have to talk to a lot of people. Here, it's a sales thing. You're going to have to talk to a lot of people. You're going to have to run your numbers. You're going to have to be told no a lot. Like, no, leave me alone. I mean, I had somebody to me that the other day. I was reaching out to somebody, and so I was going through LinkedIn, and I was looking in the title for accredited investor, right? And so I've been connecting with people, trying to connect with people. So this guy had accredited investor in his thing, and I reached out to him and said, hey, this is who I am. This is what I do. I would just like to connect with you. And he's like, no, thanks. Like, you know, I'm actually kind of cool, but, you know, okay, whatever. Like, you know, you're good. I was like, okay, whatever.
Industry icon, but he doesn't recognize it.
Yeah, so I'm just like, you know, it's fine. And maybe people are interested in real estate investing. I don't know why. It's like silly to me. To me, it makes no sense. But okay, you know, when it's not for everybody. You do you. It's okay. It's fine. But, you know, you're going to get told, even me, I got told no like a couple days ago, right? And so you get told no because not everybody knows me. And so, you know, but that's just part of the game.
Yeah.
It's part of it. So you get told no a lot. And you just don't give up. You just constantly talk to people and tell them about the deals that you have, and you know, and evangelism that's kind of how you have to be. You have to understand that a real estate opportunity, for someone offering somebody an opportunity to invest into a private real estate deal, is a big deal. Not everybody gets to play in this arena. Not everybody gets to participate and make a 20% IRR. And that's being conservative, because I'm always conservative, right? So they're going to make a lot more than that. Not everybody gets to make that. They're stuck in the stock market and investing in their 401k or whatever it might be. And they're stuck with the stupid returns they're going to get. And they're beholden to the stock market because they can't invest in anything else. That's the only choice they have, right? So because they don't have the time to look at whatever. So if you are offering them, because they have no time to invest in flipping houses themselves, right? And they have no time buying single family properties themselves because they're busy, but you're able to give them an opportunity where they can invest in real estate, make the same returns or close to it. And you can't be evangelistic about that, then there's something wrong with you, right? I mean, it's like you're providing a fabulous service to people. They can make more money. You know, yes, you're raising capital because you want to get your deals done, but at the end of the day, it's a great deal. It's a fabulous deal. Now, not all real estate deals are great, but if you're picking the ones, you're picking them right, and you're doing your job, it's even if the property makes 5%, right? Even if it does that, the tax benefits alone save you. Right. And so if you're doing your job and you're doing these right things, now, of course, I always want to make 20% of my money. I don't want to make 5%, but, you know, because there's, you know, inflation's like 6% or something. Holy crap. But so
closer to 7 right now. It's insane.
Oh yeah, it's nuts. But that's real estate is the best hedge against inflation, because if anything goes up, real estate goes up too. Like, right. So it's just fine. So you should park your money there. So you have to be evangelistic about, I don't know why I have a hard time saying that damn word, but you have to be that way about your deal, because if you do, then people will inherently want to be a part of it, because enthusiasm breeds attention, and attention breeds, you know, people understanding what you're trying to do, and then they'll, you know, inherently like you and trust you and all those great things. But there's, you know, we provide a great service. Yeah, we do. And I would say that, I mean, not only are we providing great service to investors, we're improving communities. We're doing good things for the world. And oh, by the way, yes, we're real estate investors. No, but we're doing great things for the world. I mean, every tenant at my properties thanks me. I've been thanked, but you have no idea. Like the ladies that will come and going, thank you for buying this property. I feel safe now. I mean, there's things like, I mean, when you do it right. I mean, because I buy Class C properties, right? So I buy ugly, right? So I'm in the multifamily land of, they're waitresses and construction workers and oil and gas workers, and they just want a safe place for their kids to play, right? They can't go buy big houses and they can't go do those things, but they want a safe place for their kids and they want them to have, better than they did. So, which is cool. And so that's what you do. I mean, if you get into Class C land and you're providing a really nice community that's safe and secure, and you don't have to worry about the drug dealers driving by and all those other things, because you're doing your job as an operator, then it's a good thing. So you're improving communities, you're improving the neighborhoods, you're giving your investors a great return. Why wouldn't you want to be in this business? Like, really? Yeah, it's really hard.
Could be related to ignorance, but
yeah. For everybody, it's tough. It's tough.
You touched on an important topic. We're briefly gonna go there, but before then, if you haven't checked out Capitalracesclubcom yet, please do. That way you get notified next time we go live. Yeah, please do. So that's it. The question was, when you were talking about not just the returns, but also the tax benefits. So I don't know if you want to go and touch on that a little bit more. Why is it more tax beneficial than say other securities like stocks and whatever? I don't know if you want to go there, but we can also.
Okay, I mean, I can do. There's a lot of tax benefits to real estate. So one of them is depreciation. So what happens is every year I give a K1 to my investors, and it's negative.
What is a K1?
A K1 is what you have to take, like your W-2 from your job in order to get your tax return. You get a W-2 or a 1099 or something like that, right? So your K1 for me is the record of your investment with me and how well your investment with me did, right? You're going to get a K1. And so it's like showing, okay, you invested with me, and oh, by the way, basically you didn't make any money. Oh, so sorry. But you have been. But what happens is because the IRS allows you to do things like depreciation and your CapEx expenses are below the line and all these other things, your real estate properties to the IRS should never make any money, right? We never pay taxes, ever. So I never pay taxes. I'm a real estate investor. I never pay taxes, like not once. And why do I never pay taxes, and why will it never change? Because, everybody in Congress is a real estate investor. But it's because, and everybody thinks, oh, well, yeah, that, real estate investor, you're not paying any taxes, whatever, right? No, because real estate investing is like, if you took the construction and real estate industries, that is about 25% of our economy. And so they want to incentivize that. And of course they want to incentivize it because, we bolster the economy. So if we can, as investors and developers and those great things, not pay real estate taxes, and it encourages more people to real estate investing, like the opportunity zone thing, right? So if you're in an opportunity zone and you hold that sucker for 10 years, you never pay taxes on anything, not including gains, right? That's another event. So there's depreciation, there's opportunity zones. If you have a real estate professional in your household, right? And somebody else has like a W-2 job, like, they're not a real estate professional, say they're, I don't know, manager or wherever, you can offset up to $150,000 of their income. They don't have to pay taxes on it because the spouse is a real estate professional, right? There's all these different things. Yes. You have a question?
Question. What does it take to become a real estate professional?
Yeah, you have to be full-time in real estate. So either an agent or you're like an investor or a property manager or something like that. There's a long definition, but basically you have to be doing it full-time and not doing anything else. That's all you do, is you're a real estate professional. So yeah, so there's just a lot of benefits to it because the government wants to, like they try to incentivize everything else. The opportunity zone thing was also an incentivizing people to develop, lower areas. So that's why they did the opportunity zone thing. Senator Tim Scott is a genius. We should have done this a long time ago. It's bred so much development into areas that were being ignored and were blight on communities. And he just, by classifying these areas, and you don't have to pay any taxes if you hold on to it for 10 years or whatever. That spurred so much development on all those areas. And when you go and you develop and you increase property values and all of those great things, it just the economy changes, right? And so it's a great deal. So those depreciation, the opportunity zone thing, not having to pay on capital gains. You obviously can do your 1031 if you want to avoid gains. So it's all about when your taxes are going to hit, right? And then how you minimize your tax bill. When you have all your investments out, you're not going to really pay any taxes because you should depreciate everything anyway. But it's when you sell, like when you get like a big gain from either selling, is generally when you might have a tax bill. So there's all sorts of tax strategies around putting it into a deferred sales trust or using a 1031 or using a personal trust or all these different things. There are tax strategies around real estate that basically you don't pay taxes. If you're paying taxes and you're a real estate investor, find a better CPA. Just saying. Just saying right now. Find a better CPA because you should not be paying taxes. Just say it. You should not.
What are the core values of your company with Tiemann Properties?
Oh.
What else? The mission, values, and sorry, I had the question.
Oh, yeah, sure.
Yeah, because you're improving communities where you go. Yep. Like you said, you're buying properties that are mismanaged and mishandled, and you're taking care of the community that way. So we already got a glimpse of it, but could you tell us what drives you in your business?
So I think it's that I'm a contractor at heart, right? So I like being able to go back and go, hey, I did that. I made that better. Like I built that store, or I built that community, or I did this, or I did that, right? That's cool. Like you're ending, because I build things and I improve things, I end up having a legacy that I can leave behind to the neighborhood, right? So it's about building legacies, right? Like that you can leave and you can change communities and make them better and do things like that. I think if you were to ask me which is more important, the mission, the vision, or the values, I think they're all equally important. I think your values your values are basically going to bolster your mission, right? And your vision of what you want to do is defined by both your mission and your values. So they're all kind of equal. Our values are like, and that's one of the things, like, so you're improving communities and you're improving the lives of your investors, but I also improve my lives and my employees. My employees are paid very well. I do not have anybody on minimum wage working for me, right? So everybody's on a salary, everyone. And I, as best I can I don't property manage anymore. I used to property manage, but I, as best I can, try to share in some sort of performance with the property management companies that we do end up choosing. I'll get those employees involved in that stuff too, right? Because you want to make sure that the people who are actually running your business at the end of the day, down at the very ground level, have a vested interest in it. And they're going to stay because, if you're sharing some of the wealth, they're going to stay. So if you're improving lives overall, whether it's your employees, your investors, or the communities that you're building in, if you're improving lives, that's a good thing, right? That's a good thing. In our team, we value honesty and candor, like more than anything. We value diversity. And diversity is like, it was coined and everybody, but my thing is, I don't think you can have true diversity unless you have candor. If you're willing to let voices be heard and you appreciate then diversity can really work at its best, right? Lots of times I've been in large organizations because I worked in tech or whatever. It becomes this culture that works against you because everybody thinks the same way. Nobody's going to rock the boat. No one's going to say the things that need to be said, right? And that's me. I'm the girl that's going to go, okay, people, this is stupid. Like, this is the dumbest thing I've seen since whenever. I can't believe we're doing this. Like, that's me. I'm willing to like be the sacrificial lamb because I'm just like, this is so dumb, right? And so that's how my organizations are. If you have something to say to me, you can say it, and it's free and it's fine, and I'm not gonna fire you for it, and I'm not gonna like you think we're doing something wrong, or you're like, I had an employee come to me the other day. I fired my marketing agency, no joke, because an employee found that they were running something that looked like they were baiting and switching people. And I'm like, that's not who we are. We're about honesty, right? And so it was immediate to her. She goes, Amy, we don't want to be running that ad. I'm like, that's right. We do not, do we? And she goes, I got to go fire them. And so she did. So it was, and they took it upon themselves to do it. But we run, one of our biggest values is honesty and candor. And so it's like, we want to be very transparent. We want to be very upfront about everything. And sometimes it's hard. It's hard to tell an investor, oh, by the way, I didn't have a crystal ball and the supply chain, I did not anticipate this happening. And oh, by the way, I can't make your distributions this quarter because holy crap, we can't get damn appliances. And so, but telling it to them and then also telling them, stuff. We had an investor call where I had to explain to them, oh yeah, they're expanding the highway. And I had no idea. I had no idea. And our property's right on the freaking highway. And I probably should have known this, but I didn't know. And so now I'm having to regroup and figure out how this is going to be and, and the implications of this. But I got to make you aware. I got to tell you. And, in our due diligence, I don't know why we missed it, but we did. We missed that the highway was being expanded. Now it was all kind of right around the same time. But I took the blame. I said I should have known. I should have found out. I should have done something. But that's kind of so where it's all about candor and honesty with everybody, the employees, our communities, and our investors, because I think it's just the best way to be. And sometimes it'll hurt you. It does hurt you. I mean, sometimes people will run with that and they'll blame you and they'll turn it into something evil because people are weird. But I'm not going to change who I am. I'm going to change who my company is because somebody chooses to badmouth me. I mean, there's always going to be people that badmouth you. Like, welcome to the business. You got to be tough. Like, get over it. Like, people are going to badmouth you. So and people are going to say all sorts of crazy things about you, and you just do what you do. And if you're doing the right things, people are going to know. And people are know that people are bad mouthing you, or it's not right. It doesn't jive with everything else about you. And so it's not going to make any sense to anybody. But yeah, so you're putting yourself out there. When you're running a business like this and you're raising capital and you're taking people's money, you are going to be under the scrutiny of everybody. That's why we choose candor and honesty, right? Because you're going to be under everybody's scrutiny anyways. You might as well just tell them, I'm always fairly blunt with you anyway. I'm not going to change who I am now, right? I'm not going to now, I'll use tact. I have learned to do that after getting yelled at and losing friends. But, we have all sorts of crazy things. And so we have to do what we have to do. And candor and honesty wins out usually, always, and being kind to people helps.
That's a great statement to live by and to lead by. And you're an incredibly successful business leader. And the question is, which 3 traits do you think are the most, or were the most instrumental in your success or to your success?
Oh, okay. I would say when you're running an organization, so my degree from Purdue is in organizational leadership. So it's around organizational development. So if you're going to be a leader of an organization, you need to know how to structure one, number one. Like, you need to know how to, or if you don't know, you need to be self-aware to, so first I'll go because I'm going to skip around. It's cool. But, so structuring an organization is number one, right? You got to know how to structure one. You got to know how organizations in themselves work and what works best and how to motivate people and all those great things, right? So as a leader. Second is you have to make sure that the systems inside that organization work really, really well, right? We work on this all the time. I have meetings on it every week to talk about, okay, we know we need to improve our systems, right? It's not stopping. Our systems need to get improved. But what happens is that you need to, you have to make a conscious effort to do it. You have to, so as a leader, you have to work on your systems. And the first thing you always want to do is not blame the people, right? Because most of the time, if it's not working, it's really the system. It's the process or the system that's not working. It's not your people. So if you look at the processes and the systems, and if those are all working correctly, like the way it's supposed to be, and then your people trained on what they're supposed to be doing, and they're actually trained really well, then at that point you can maybe blame the people. But but if you have, until you can get all of that squared away, like you're doing that, and your organization's humming, and it's got good systems and structures and all of those great things. As a leader, a lot of people just want to, just hire people and then magically know what to do, and they magically make your systems run. And oh, by the way, they don't even know what the hell those are, right? And so they're just supposed to figure it out, and it's very difficult to put people in that situation. So you got to do a job as a leader to do some of that kind of stuff. So I think my background in organizational development helps. I think hiring and being able to hire the right people. And set up your organization in a way to be very, very flexible also helps you, right? You can't get stuck in such a when you're developing your systems and processes that you get so stuck and ingrained in certain things. Focus is great if you're on the right things, but if you're focusing on the wrong things, it'll lead you down to the wrong path. So you got to make sure that you're working towards whatever you're pointing your organization to is the right place to point. And that's your job as a leader, right? Your job is to focus on the strategic and get yourself out of the tactical. And and the only way to do that is through great time management. So that's the third one, right? So I have to in my calendar every day, I have to structure, it's like I do 20, 50, 30. So it's like 50% is on like the productivity stuff I need to get done, right? The 20% is on me and my health and just improving myself. And 30% is on being strategic in my company and what I need to do. So I color code my calendar, making sure that I'm hitting my 20, 50, 30 every week. And you have to do that. You have to focus on yourself, because if you don't focus on yourself and all you do is become a workaholic, your company will fail, right? Right. So you have to make sure you're healthy. You have to make sure you're taking care of yourself. You have to make sure you're eating right and exercising and doing all those great things and not getting high blood pressure and anxiety and stress and having to take Xanax, right? Like, we don't want to do that. That would be bad, right? That's not sustainable. So if you work on yourself, it's sustainable. Being strategic is just sustainable, right? You have to pull yourself out of the tactical and look at your processes and look at your stuff, and you have to do that, right? But then at the end of the day, crap's got to get done. Right. So you got to get that done. And if for some reason in that 50% of your week, and I'm working a lot of hours a week, no joke, if in that 50% you can't get something done, then you got to financially find a way to hire somebody, because you still got to get it done. But you don't want to be working 100 hours a week. I mean, I get that you have to do it initially. You do. You have to do it initially because you can't hire anybody. You don't have any money. But eventually you have to learn to save money so that you can hire people. And there's a point where you're not paying yourself very much as an entrepreneur. You're not living high on the hog, right? You're putting money back into your business initially so that you can scale, so you can live on the high on the hog later. There is that point. We are in that growth spurt of stuff. And I've gone through it in the construction company. And so I'm going through it now in my real estate business, right? So where I'm not, partying every weekend, and I don't have a big huge house, and I don't have any of that kind of stuff. I don't think I'll ever have a big huge house. It's just me and my little boy right now. I'm not that person. But I think you do strategically put whatever money comes in back into the business so that you can grow the business, because it eventually will help you. There's a really good book called Scaling Up. Great book. and it helps you grow. And it walks you through. It's kind of written like somebody like me who's really blunt and straightforward. It's really, so that's why I probably like it so much. It's really just like gets down to brass tacks about what you need to do. But it talks about the key things, which is, obviously people, money, resources and marketing. And that's what helps your organization grow. And if you're not focusing on those things, then you won't ever grow. So, yeah.
That was, I think we're going to have to capture that as a video on its own.
Okay.
It was highly, insightful. Thank you. Yeah. I would like to ask, are there any insights or lessons that you've learned throughout the years that we didn't cover today and that you would like to share with the audience?
I talked a little bit about this, but I think the best thing I can leave you with is like, be self-aware to know what you're not good at. And that's the first hires you're going to make are the stuff that you just, you're just not good at it. But it needs to get done. And don't be so prideful that you won't hire somebody. There's a lot of people that will like not hire because they think they can do everything the greatest. They're the greatest thing since sliced bread, and they can just do everything fabulous.
And, I think I'm one of those.
Yeah, exactly. It's like, if you want to do it right, you got to do it yourself. That is stupid. Whoever said that is stupid because it's not true. And you will never grow and you will never scale. And so you've got to be really honest with yourself on, okay, what do you procrastinate doing? Because that's just the crap you hate doing. Like, just if you procrastinate in it and it doesn't bring you joy, it's not what your talent is. Okay, who cares? Go hire somebody. Go use a service. Outsource it. Find a way to financially take care of it because it needs to get done. And you just figure out a way to pay for it. And you can. It'd be a magical thing. Like, if you really had to find a way to pay for something, somehow, you know what? You find the money. So you do. You plan a way. You plan around it. And when you plan around it, plan for it, then you can get it done. So that's a part of it. And I think so. That's the first step is hiring people stuff that you're not good at, so you can get that stuff done. But then as you grow out of that, because you don't want to stay in tactical forever, then you got to find people who are good at what you do. And then you've got to hire people who are good at the stuff that you do and maybe better than you. I always try to hire somebody who's better than me because I know that's going to be a good thing. As long as I can, if I have a bunch of, racehorses in my stall and we're running a race, I know I'm going to do just fine, right? Because they're all racehorses, right? Yeah. Not everybody has to win at the time, but it doesn't matter. We're all going to get to the end, and they're all like thoroughbreds, and we're all going to make it, right? And because they're good at what they do, right? So, and so it's fine. But that in itself, going from not hiring anybody to now going, oh, okay, and now being prideful in that to hire, oh, okay, well, yeah, I suck at accounting, so I probably should hire an accountant, right? That's usually the first one. And so then you hire that, but when you actually have to hire somebody who's good at what you do, that's another pride check. It's another pride check for you to go, oh, okay, and you have to get through that emotion of, I cannot stay there. My company cannot grow if I stay there, right? If I'm working on asset management all day long, my company will not grow, right? I'm a great asset manager. I can get in the weeds with the best of them. And I am a property manager's worst nightmare, right? Because I've been property manager forever, but my company can't grow if I'm the asset manager, right? So I have to go hire other asset managers. If I'm the only one raising capital. Now, I think I'm fairly good at raising capital, but if I'm the only one doing that, then my company will not grow. And the other things I'm good at is finding good deals and underwriting deals, but I can't be the only one doing that either, right? So it's an interesting thing. But so you go through as an entrepreneur several checks along the way of your pride, and you have to suck it, like eat it. You have to eat it. And because you're the leader, and it brings on all sorts of other dynamics and leading people and all that great stuff. But it's really interesting. It's more about the leader than it really is about people. So it's just kind of funny.
That was a great insight. Thank you for sharing that. We have Dominic Green from LinkedIn asking us, how did you go about finding great partners and forming mutually beneficial partnerships as you grew your real estate investment business?
I'll
Let's do
tell
a question
you.
from the audience, Lori. So
Yeah, it's cool.
wrapping up.
Yeah, I like that. So I, as you network with people, you will know folks that you resonate with, that like that you think they're talented, and they kind of like have the same drive that you do, and they probably are talented in areas that you're not in, but it's all through networking. So a partner I have on the Pasadena deal is, his name is Justin Smith. He's a multifamily developer out in San Francisco, and I met him through networking. And I love Justin. Justin's a cool dude, and we get along, and he kind of has the same value. Him and his family are awesome, and we have the same values, and we talk constantly, and we we're doing this deal together, and he's a developer in construction, and I am too, but he still has different skill sets than I do, which is really kind of neat. And so, but we can get along, and we can talk. But I find him through networking. And I just, because I've hired so many people, basically you're hiring your partners too. So it's the same kind of process as you go through, and you talk with them, and you kind of find out who they are, and you kind of find the struggles that they've gone through, and you do all of those things. You want people who has had to face adversity, right? And that are still in the game. You want those people, right? Because those people, the people are going to be there in the long haul, right? You don't want the people that they expect everything to go perfectly, because when does that ever happen? Like,
I think we're up on time.
Are we? Okay. Yeah.
This was excellent. This was epic, and looking forward to hearing more about you. Where can we find you?
Yeah. So my website is tm1properties.com. You can register to invest there. You can book a call with me. We do have our offering right now for a Pasadena deal. 227 units outside of Houston, Texas, and we're currently raising capital for that, and it's a great deal. We're excited. We just got the rent rolls, by the way. For the lender asked for an update on the rent rolls. They're at 100% occupancy. Whoa. So I know, and it was not like a big feat because they're already at 97, but it's a good thing to have. It's a good problem to have when you're full, which is nice. It's a great deal. It's a great area. The seller's a really good person, and he's working through it. They just want to get out, and it's a mom and pop kind of seller. But yeah. So we're excited. We're excited about it.
You have to be one of the accredited investors for that, or?
Huh?
You have to be an accredited investor for this.
Yes, that one you have to be an accredited investor for. Yeah.
We covered that already. So for those that missed that part, please go back, take notes.
Yeah.
Thank you so much for everybody who showed up live here today, and we're super grateful for you all. And Amy, wow, we did it. Thank you so much for being here today. And we learned a lot. Holy cow, I learned a lot. And I think the audience was also, we can see the comments, by the way. So thank you all for being here, and see you all next time. See, next week, we're going to have one of these.
Next week. All right. Thanks.
See you.